Aditya Suresh, Managing Director, Head of Equity Research at India at Macquarie Capital, joins us right now on the show. Aditya, great having you as always. Thanks for taking the time out. Aditya, I don't know if my memory fails me, but if I remember the last time that we spoke, you were cautious, let's put it that way. And correct me if I'm wrong. I wonder if that mood has changed for you, considering the 2 or 3 things that have happened, namely the GST changes that have been ushered in, plus the apparent thawing of the relationship between India and the US as well, and of course India and China too, right? So is that cautious mood changing?
Neeraj and Tamanna, thank you for having me on the show. Your memory serves you correct, Neeraj. So we have had a more cautious, guarded stance here on broader markets. But just to take you back a little bit to why that was the case, right? So the core point that story is about earnings and what's already in earnings expectations, and the requirement for a reset lower from a consensus perspective. That is one. Point two is about kind of foreign flows, that being absent as a support factor. But what we did see is domestic liquidity, which is still kind of supportive, and so now they're being outright kind of underweight here in the market. The real strong domestic liquidity is what kind of still kept us optimistic, selectively looking for bottom-up ideas. To be quite candid, Neeraj, if I use the same framework, where we are today is in a similar boat, right? So when I think about earnings itself, yes, consensus has moderated earnings estimates, but are we in a phase where we think that earnings is going to be surprising on the upside despite these recent measures? We're not. And that can kind of go through by sector, by stocks, and so forth. Foreigners, again, I think there are alternative choices there, right? Say markets like Korea, Taiwan, these type of places had a stronger run back to fundamentals. So I think foreigners in itself are still not really a support factor despite this relative underperformance we've seen year to date. Domestic liquidity is still a support factor. So when I kind of put those pieces together, so I think the key thing which I'll still anchor my discussion on is around what's happening in earnings, and even at a headline level, like what we commonly speak about is, let's say that earnings for the market has to grow at nominal GDP plus X, right? But when you look at some of the real-time trends, or even if you look at the past 4 quarters, revenue growth for, let's say, MSCI India, which is a broader universe, is at maybe 5-6%. So we're looking at GDP minus rather than GDP plus, even at a revenue kind of baseline. Underneath that, we've seen margin erosion, right? And so net profit growth has further trailed that kind of that level. So we have had some one-off gains kind of supporting the recent optics, but the underlying kind of message here is that we're looking at a market where earnings growth for the past 4 quarters on a year-on-year basis tracking at, say, sub 5%. The expectation is that we kind of see a recovery back towards that low teens kind of trajectory. In that context, I think the GST kind of measures helps that. But are we in a phase where expectations are going to be really revised upward? We don't see that. So it's still quite guarded, if I may. It's very selective, very bottom-up. That's at least the nature of quite a few of our conversations.
Relative terms, Aditya, I think you're still sounding a little more positive than the last time we spoke, right? Good morning, Tamanna here, and that's a nice tie, by the way. Just want to understand whether you're seeing any positives, and I think you speak about it briefly, for the financial space. If you're going to look at further expenditure, more discretionary spending power for a consumer-driven economy, is financials the way to go, and then which direction are you headed in?
So within financials, again, so our analyst team, we're still fairly cautious. So we're not en masse going out and saying buy all NBFCs, and a lot of that is done kind of what's already in growth expectations. So at least it is our view that growth expectations in itself, if you're like expecting, say, 20% kind of growth plus some margin expansion, we don't see that level of growth necessarily kind of coming through. We are kind of closely watching kind of stress in that space. So it's a bit more kind of nuanced within the NBFC space. Within the broader kind of financials, we're still kind of more risk averse, if I may. So our positioning is more toward like an ICICI Bank or a Bharti or HDFC Bank. With ICICI Bank again, so there the dynamic is that at least our analyst is expecting that we get back towards that, let's say, a low teens kind of credit growth, some margin expansion kind of levers. But even there, with the banks, a bit of a nuanced comment, which is that like this year we're actually seeing cuts to numbers. We're not really seeing that high pace of growth. It's more about a recovery into FY27, FY28. So selective on the financials, more large cap, the common kind of banks kind of where we'd be positioned.
Okay, Aditya, but in the same vein, so if there are cuts this year, but the future looks good and which is great, then you may be partly constructive there or mixed there. What about NBFC side of the business? Because that's where there is belief that both disbursements as well as margins will look good for the next 6 months at the very least, if not longer. Is it prudent to be constructive there? And if so, which bucket? Because there are some which are proven and expensive and some which are kind of at the bottom of the valuation cycle.
Yeah, look, so I think it's a very selective, specific comment, Neeraj, quite candidly. But yeah, if you had to kind of frame it in the next, say, 3 months, 6 months, are we seeing tactical kind of buy ideas within our kind of list of stocks? We are, right? So, for example, our analyst team likes Shriram in that kind of NBFC space. We like AB Capital in that space. It's very selective. It's not an en masse buy NBFCs kind of comment. But as a broader theme for NBFCs, I think the disbursement growth, which at least we are expecting, or our analysts are expecting this cycle, is not in the 20s. Maybe mid to kind of high teens is kind of more realistic as a pace of growth, which we are thinking about. And a lot of that has to be kind of toggled with risk as well, right? So it's in terms of like how much of risk you're willing to take to kind of to cater to that growth. And at the margin, the segments which these guys are catering to is seeing a bit more stress. So I think there's a bit of kind of a response that we slow down, toggle back growth in response to that kind of emerging risk.
Among, and I'm looking at your report, Aditya, one thing that caught my eye is in your negative surprise list, you have an Eternal DMart, TechM, but talk to me about Eternal. What are you thinking of when you're seeing this? Because this has been a very favored stock, a darling of the street, so to speak. What would be your concerns in this space?
Look, so I have huge respect for Eternal, the company, and the management team, etc. It so happens that I'm the analyst covering Eternal as a stock. And what we've been really doing in our numbers is, I'll just give you a flavor, is that whilst we've been meaningfully expanding top line, that expansion in top line has been accompanied by a commensurate significant expansion in losses, right? So we've been cutting margin estimates. And I think that risk about lower margins is relevant both in quick commerce and in food delivery. In food delivery, it's more a reflection of the fact that you are at a point where take rates are high. The ecosystem is kind of pushing back and fighting back. So we'll see. This entire margin expansion story was underpinned on take rates, but the opposite of that story is also true. In quick commerce, I think the nuance there, at least to think about, is unlike in food delivery, which is an agency business, quick commerce is an inventory turn business, right? So all this kind of growth is an equivalent of you setting up another kirana shop in a kind of digitized kind of smart format to cater to that growth. So this is an inventory turn business at a specific micro market. And the specific point we make is that the throughput per dark store gets impacted with competition. And that competition is rising and continuing to kind of rise. And we're seeing competition here really from multiple dimensions, whether it be JioMart trying to come back at this, whether it be kind of Flipkart looking to expand its kind of its dark store kind of program. Amazon is kind of coming back at this again. Big Basket is relevant in that space. The entire offline ecosystem is not like just like sitting there. So I think the real problem statement, at least which we see for quick commerce, which is kind of what is underpinning a lot of these stocks and the valuations, is simply about, is there an economic profit at all to underpin these valuations? And we're not seeing that. So huge respect for the company and kind of what they're doing and the kind of TAM opportunity, but I don't see the economics both for kind of Blinkit or for Swiggy. So in Swiggy's case, the problem is far more pronounced.
Aditya, we have about a minute left, but just trying to understand. Defense in flavor for the last 10 days. Global funds now, global defense funds having India allocation. So Insti money starting to move in. What are you advising your key clients to do? We have about a minute, but if you can give us your thoughts.
Yeah, so quite candidly, Neeraj, that's a coverage gap, if I may, within our
So leave
within
that
our
out.
space.
Leave that out. Let me ask you something else then, Aditya. Capital goods again, selective positive coverage starting there. Are you guys also amongst that list?
Yeah, that's kind of the broader theme. I think this entire theme about consumption over capex, I think, is a great headline. I think we've got to be a bit more selective here on that kind of comment. What I would tell you is the following, which is that when I think about broader cap goods and industrials, there's clearly a big tailwind here, which is supporting that space. What we are seeing and observing is a moderation in revenue growth expectations, which I think is realistic. Where we do kind of worry is that margin expectations for quite a few of these companies are still too high, you know. So a large part of that kind of re-rating story underpinned by kind of better margins, better earnings, I think that's behind us. So like with most of my comments, I think we're being really, really selective. So I don't really have a comment such as overweight this sector or overweight that sector on a top-down basis, you know. So like we are kind of really aggregating this from the bottom up to get to our kind of sector picks.
Okay. You know, I just want to quickly, Suresh, just going through some of the focus stocks in your report. Very quickly, ICICI Bank are your growth leaders with visibility. Bharti, Tatacom, Titan, Trent, Marico. I see TVS, I see Uno Minda, JSPL, Ultratech Cement. Quite a wide kind of bucket. Any common sort of theme that you're seeing, and a few of them, of course, in the consumption trend?
But I think that's kind of the point of the story, is that so it's very specific, you know, rather than it being that this sector is going to en masse see a lot more growth. And again, just that I would have loved to kind of insert that bullet point itself. What I'd love to say is that, you know, within our 150 stock coverage, these are the 10 stocks where we're seeing earnings going to be upgraded, you know, in FY27, FY28. But not for the lack of trying, but we shook the trees fairly hard. We could not come up with that, right? So the way we frame this is that the next level down is about where we have strong growth and where we have visibility on the growth, and where we'd be looking to kind of index more in those kind of spaces. We also have another category where, like some of the large cap names like Reliance, Levers, for example, growth has been absent. We do see now maybe a point where growth kind of inflects and kind of revives a bit. That again lends a little bit of support. But yeah, so I think the real theme there was about we're really calling out or indexing heavily towards names and stocks where there's a good thematic exposure, there's a bottom-up kind of story, and we have visibility. It's not really a case of earnings surprise in the upside.
Thank you so much, Aditya. In fact, in his growth revival list in this report, there's RIL and Hindustan Lever. In the negative surprises are Eternal, DMart, I see TechM, and Max Health, among others. Thank you so much, Aditya Suresh, for speaking with us today.